The big money sees what's coming, they know what's coming, and they do things. I'm going to use a little bit of profanity, and please forgive me, but I want to get the point across. Whoever is doing this, every month, month over month over month over month, they do not fuck around. When they're spending hundreds of billions of dollars, they know where the puck is going. Wayne Gretzky, the greatest hockey player ever, his famous line, I don't skate to where the puck is, I skate to where it's going.
Monaco 64, home of alternative economics and contrarian views. Well, today I have pleasure of speaking with my friend Andy Schectman. He's the president and owner of Miles Franklin, one of the premier precious metals dealers in the U.S. Andy, great to have you back on the channel.
I wish you were. I could say I wish you were here in Florida with me, Mario. This is about the time when I saw you a year or two ago, or we were playing some golf. But I'll take it any way I can get it. It's good to see you, buddy.
Yeah, it's a year ago. I mean, time goes by so quickly, doesn't it, that you kind of lose track.
Yes. Well, you're always welcome back, just for the record.
Yeah, thank you. Thank you. Andy, I was looking at your website, and there's a box right on top, which is usually not there. And it says, due to unusually high demand, we experience delays in processing, shipping, and customer support response times. We appreciate your patience and apologize for any inconvenience. And the reason I'm bringing this up is not to have a go at you, because I see a lot of other dealers with that same problem, actually in the UK as well. The reason I want to talk about this is that the markets have come off in the last 10 days quite a lot, especially silver. And you'd think people wouldn't want to be buying gold and silver anymore. You know, they sold everything. So how do you explain that? What's going on?
We had record year last year. We did a third of the business we did all of last year in the month of January. The industry is on fire right now, Mario, and there are a lot of people, thanks to guys like you, who are aware and keenly aware of the forces that brought the paper price down, which are detached from reality in many respects. Yes, it certainly was something that affected the psyche of a lot of investors, especially new investors, but I think that the people who understand what is happening understand that this was a paper contrived smash, one that was at the heels of margin hikes that really went after the leverage players, which knocked the price down considerably. But I think when you take a look, for example, at the March Comex numbers, there's still almost 81,000 contracts of open interest open right now, which that I guess that sounds maybe that sounds abstract until you understand that there's 5,000 ounces of silver per contract. That's 402 million ounces of paper exposure tied to the March contract, where the first day of delivery is 2.5 weeks away. The big money, who doesn't play with margin, who's been standing for delivery every single month for the past 15 months, they're the benefactors. They're the ones who benefit from this smash down in the price of gold and silver, and the big money understands that. By the way, there's 402 million ounces of paper exposure tied to the contract, with only 103.5 million ounces in the registered category. What could possibly go wrong? Parallel to the same kind of conversation that you've had many times with the amazing David Jensen, who talks about a similar situation in London, 2 billion ounces of open contracts with 140 million ounces standing behind it, or something like that. Same thing we're seeing here on Comex. This was a desperate act to get, I believe, some of these large players who are offsides in a big way, who were bleeding as the price kept going higher, maybe to get them to cover one last chance. It certainly wasn't normal market fundamentals. And, when you see a price get hit that way and then in 2 days come back 35%, the volatility is extraordinary, but I will tell you that nothing changed. In fact, maybe only the fundamentals got stronger. And that's manifested into record demand. The interesting thing about the record demand, Mario, is that still is void of the majority of the mainstream public. It's just that the people who get it are doubling down and adding more and becoming more concerned about what's happening with the economy and the system. And it's just manifested itself as record volume throughout this entire industry. So it's not just the dealers like ourselves. It's the IRA custodians. It's the depositories. It's the shipping. It's everything is all but gummed up. And when you add record margin hikes into it, which keeps the refiners from taking any new business, in fact, stop taking any business, because understand that if they have $25 million worth of silver and gold that they are refining, and it takes time to refine it, break it down, refine it, and turn it into bars or whatnot, the amount of time that that's taking, in particular with silver, this whole way up, they've been getting margin called not only with the price of silver rising, but with the margin increases. So if they have 25 million in inventory that they are in working progress to make it, from an unrefined doré or junk silver or flatware or whatever that's being melted down, turned into shot, then turned into bars, that takes time. Well, the price of silver, they sell the exact same amount that they have that they paid for from the public on Comex, so they're market neutral, right? Well, the prices had been going up so fast they were getting margin called, and then they raised the margin requirement so high that they're getting margin called, which is put them out of business type of environment. So they stopped taking any new business, and they are a huge source of revenue to the industry and liquidity. The liquidity's dried up in many respects, and it's just created a gummed up system where things are taking far longer than all of us are used to experiencing.
Yeah, and you mentioned the Comex margin hikes, but they also did trigger the
Circuit breakers.
yeah, they didn't.
Yeah, how'd that happen, right?
Yeah,
How'd
twice.
that? Yeah.
Twice.
Well, it's just like when Jeffrey Epstein was in this maximum security federal prison, that the guards fell asleep and the cameras didn't work for once, right? So they just happened to fall asleep and the cameras just happened to not work. So we don't really know what happened. I mean, it's a lie. Everything is silly when you talk about the circuit breakers glitched twice, right? And allowed it to free fall. Well, at the same time, you look at JP Morgan covering 700 plus contracts at the exact bottom when this happened. Or if you take a look at the ETF, SLV, when the price fell, right at the time the price fell, and amazingly so, there was a jump in SLV's shares by 37 million shares. And so at 0.905 ounces per share, that's 33 million ounces of silver added in one day. Now, they added that at the very bottom. So in other words, the authorized participants create those shares like JP Morgan and Goldman Sachs, and they do so by delivering physical metal first. So think about what that means. Silver gets destroyed, and immediately after the smash, not only does JP Morgan cover 700 plus contracts, but tens of millions of ounces show up inside the ETF. And that tells you that, this was a forced liquidation and a margin event. And at the same time, they use that event to source physical cheap and inexpensively and park it inside the exchanges where they control it, inside the ETFs. And in my mind, this is forcing from weak hands to strong hands silver, from forced sellers to institutional vaults. And, I don't know. I think that when you line up the delivery pressure, the tightness in the registered inventories, the big stops that we've been seeing that are breaking, the circuit breakers, this isn't normal flow. This is inventory reshuffling under stress. And I think the most important thing to take away from that is that in periods of chaos and violence, markets do not reveal the truth. They only reveal the truth after. And price is the weapon or the misdirection, the tool of misdirection, and inventory is the confession. So yeah, they can use the price to freak everyone out, but the inventory on both LBMA and on Comex are speaking a far more accurate truth. And that is that this is something that is going to get a lot more volatile, probably a lot uglier before it gets better, in the respect that the amount of entities that can possibly stand for delivery are way outpacing the amount of silver and gold that are inside the vaults. And I think ultimately you see much higher prices as a result of this imbalance.
Yeah, and even in China and Shanghai, the futures and the Shanghai Gold Exchange,
Yes.
Their inventories are falling like massively.
Yes, they
So
are, and that's happening everywhere as a result of the insiders that are understanding what the Western silly price is all about. And so they're not only are the inventories falling, but they're falling using the fake price that we have here in the West as a guide. Now they also have the arbitrage that we're seeing in Shanghai, where they are pricing the metal much higher in Shanghai by over like $30 higher than the West. And there's a lot of confusion on that. A lot of people will say, well, what about the tariffs or the VAT tax?
yeah, VAT, yeah.
But that's wrong, and I think people aren't understanding this because the VAT tax is not the responsibility of the shipper, it is of the receiver, and only when the metal leaves Shanghai. So in other words, if JP Morgan delivers 50 million ounces of silver to Shanghai, they're getting the $30 per ounce spread. The receiver doesn't pay that tax until the metal is moved out of the Shanghai Metals Exchange. So it's not on the onus of the entity
Yeah,
shipping it.
yeah, Eric Young, King Kong 9888, he's done a lot of like work on that, trying to dispel this myth that there isn't a spread between the West and Shanghai. All the prices that are quoted in Shanghai and gold and also the futures exchange, they're all like net VAT, and they're still like $10, $15 higher. And Andy, you talked about registered inventory. It's dropping like 103 million only left on Comex, and we're seeing in January there's loads of delivery, and also in February now, and these are not even like the front months. But I read this kind of article by a guy. I'm not going to use his name, but he's a former JP Morgan bullion banker, and
I
he
read
said
that
that,
too.
yeah, and he said, oh, it doesn't matter because the eligible inventory is still there. But I didn't think you could deliver eligible
You
in.
can't, and that's just again, pardon my French, but that's bullshit, because the eligible category, for example, Miles Franklin has a storage program with 8 vaults throughout North America. One of them being in New York City at JFK. That is a Comex vault, and I have clients with all together millions of ounces of 1,000-ounce bars in that vault. They are considered eligible. They are not for sale. They are not going to be sold anytime soon. Now, you can add eligible, and I think when you talk about, I mean, look, to that point, the only thing that I could think about that makes it relevant, even a little bit relevant, is that yes, it is ineligible, right, and it is could move to registered. But I think that the issue is not about a Comex market falling. The bullish bet isn't that Comex defaults. I think it's simpler, and that is that the price of immediacy rises. And to your point, or to his point, that the market has to pay up to pull eligible metal into the deliverable pile, which is registered. In other words, this backwardation that we're seeing, so to speak, if the price got so high where you are enticed to move your metal out of registered, the deliverable pile, or excuse me, out of eligible into registered, the deliverable pile, fine. But that eligible metal, much of it is not for sale and is in tighter hands. Some of it could be coaxed, I guess, but it's
Maybe
even
at
if you
maybe at $1,000, Andy.
right, but even if it's true, but even if you add that eligible into it, there's 294 million ounces of eligible and 103 in registered. So put it together, what do you get? 397. There's 402 million ounces of paper contracts. So if you take all of the eligible, most of which isn't for sale, and the registered, you're still short. Barely, but you are. The point is that we're getting closer and closer. And so, it's if 20% stands for delivery, that's 80 million ounces out of 103. If 10%, it's still 40 million. I mean, you're talking about a huge chunk of registered that could easily disappear, and that's what will make the market react. And that's what would pull, perhaps, especially with the leverage being knocked out of this market, it could very quickly pull metal out of eligible at a much higher price. But until then, no, that's saying something that's stupid.
Yeah, I know. And yeah, maybe we could. Oh, by the way, you might be wondering, why is Mario having wine? He never does that. Because
I know the real Mario. I had dinner with you a few
no,
times.
yeah, well, it's because Andy and I were supposed to have be interviewing a bit earlier, but we kind of mismatched the times.
What do you mean, Mario? It's 9 in the morning in London right
Yeah,
now.
yeah. And so I went to have dinner. I didn't think we are gonna do the interview, and I had some wine. So I said, why not continue? But anyway, Andy, maybe we
Why
could,
not
yeah,
continue? I agree, my man.
yeah. Why not switch over now to like the U.S. economy, the financial markets, private, the shadow banking system, the Fed, the dollar's looking weak. I mean, the people I speak with and they are well connected and big investors. And they tell me that the Fed is concerned about liquidity, and it makes sense because if foreigners are buying a lot more gold and not going into treasuries, there's a problem. Do you detect any of that, and how do you think it could play out?
Well, of course they would be concerned with that liquidity. This is a game, if it were a word, where de-treasurization is more valid than de-dollarization, in my opinion. And it is all of the countries around the world that would trade in dollars, we're seeing that through de-dollarization start to wane. Well, when you have all of those excess dollars, you have to put them into treasuries. The investing in treasuries, which has kept our asset prices high and our interest rates low and our goods cheap at Walmart, well, that's been a real benefit to the West for a very long time. And you're right. Who is going to finance the debt in the absence of countries like China and Japan, who are having to unwind their carry trade and do so by selling U.S. treasuries? China dumping treasuries down to, I don't know, between 600 and 700 billion from a couple of trillion that they had a few years ago. I guess we're supposed to believe that the UK, where it's like two drunk guys leaning against each other at the end of a night, not to fall down, you got two of the most insolvent countries on the planet buying each other's debt. Stupid is as stupid is, I guess, or stupid is as stupid does, rather. And then you look at it, we're supposed to believe the Cayman Islands is one of the biggest buyers of our bond market, of our debt. Doesn't seem right to me, but the point I'm getting at is, yes, they would be foolish not to be concerned of liquidity. And this is, maybe that's part of the problem that we've seen in the repo market stress as of recent, where the big banks don't want to lend overnight. They don't want the mortgage-backed securities. There's not enough in the way of treasuries out there right now for them to take. They don't want the mortgage-backed securities. You're seeing a liquidity issue, a trust and confidence issue. All of these things are coinciding at the same time. And yeah, I mean, it's more of the same, where the Fed is the buyer of last resort and creating money through shell accounts in places like the Cayman Islands, trying to create that liquidity so they don't have to step in and throw money into the overnight lending market as they've been doing, because there's not enough liquidity. And at the same time, a issue of loss of confidence, loss of trust amongst not only institutions but also collateral. So it's a very weird situation. You bring in a new Fed chief who is supposedly very hawkish, which I don't really believe, but yet we're told he's very hawkish. And I think he's hawkish more so on the Fed's balance sheet. I think he's more critical of easy money and QE, but I think that label is more about restructuring the Fed than crushing inflation with hikes. So I think he'll be accommodative, I guess is what I'm trying to say. I think that he will not raise rates at a time when there's a liquidity issue, and I'm sure Trump had vetted him quite well to make sure of that. But that makes great sense, and this ultimately will boil down to a liquidity problem. as bullish as it was by extending all of this liquidity, easy money and low interest rates for all these years, the reining in of said liquidity can be ultimately far more damaging and dangerous and bearish. So I wouldn't bet the house against him raising rates. In fact, I would think he will try and do both. Lower rates while retaining some form of monetary sanity and trying to regain credibility in an institution that certainly might be looked at cross-eyed these days.
Yeah, I mean, if you look back at Greenspan, when he took over, he was supposed to be a free market guy, gold bug, and I mean, he did more to institute this Fed put than anyone else. So with Warsh, yeah, he's supposed to want to rein in the balance sheet, but there's also talk that he wants to cut rates, the Fed funds rate, and there's even talk recently that he wants to do yield curve control. And I think when push comes to shove, if there's a major financial crisis or liquidity crisis, he's going to do QE again as well.
Well, I think that the Genius Act, which goes into effect next year, will cover the front end of the curve. It will cover the keeping the federal funds rate at or near zero. Every time money moves, it will be backed by 90-day or less treasuries. Synthetic demand for the treasury pushing interest rates down on the front end. Yield curve control, sure, I could see that. But that's where Judy Shelton's idea comes in, and we'll see if it's real, where you peg the back end of the bond market to gold. So any way you look at it, I believe the front end, the federal funds rate, will be at or near zero. It will lower. The back end, in terms of yield curve control, well, they can't really say that that's what they're going to do, but they probably will. They probably already are. That's the Cayman Island account. Do you really think the Cayman Islands is like number 2 or 3 largest holders of U.S. Treasuries? No, they're not. It's Fugazi, but that's for another conversation. But yeah, I think that that's what they will try and do. It's all about maintaining not only a low end, a low federal funds rate to inspire lending, borrowing, short-term borrowing, keep the front end low, but at the same time, who wants to buy our treasuries when we have this kind of fiscal irresponsibility, $1 trillion in debt accumulated every 100 days? And I always love throwing it out. How long ago was a trillion seconds? 31,688 years ago. And that 38 trillion neglects the unfunded liabilities of Medicare and Medicaid and Social Security and government military pensions. You're 200 trillion in debt. And who the hell wants to buy our treasuries when they can be weaponized and have been as fiscally irresponsible, we have been, as anyone on the planet Earth? And so you're right, yield curve control probably will be something that will be implemented. Wouldn't be surprised if it's already in place quietly through proxy entities like those in the Cayman Islands.
Andy, last time we spoke, you speculated that Tether USA, which is different from Tether, is a front for the U.S. Treasury, and they've been buying gold.
Yes.
And also they've been buying royalty companies, gold royalty companies. And I think they're still buying like 30 tons of gold, if I'm not mistaken, a month.
Yeah.
And the reason I'm asking you that is, do you think the Treasury is thinking about revaluing the price of gold so that they can help smooth this debt problem? Because if they revalue it to where we're now at $5,000, I've calculated the Treasury would get a 1.2 trillion windfall from doing that.
Well, I mean, did you see the article from Van Eck Funds? Van Eck Funds says if the dollar loses its reserve status, it could go as high as $182,000 an ounce, from 39,000 to 182, something like that. You use Judy Shelton's theory, where like for example, Tether, who is the primary, and you look at the CEO of USA Tether, it's Bo Hines. He was Trump's crypto czar through August. He's benefiting from the laws he implemented. You look at Stephen Miran who filled the vacated spot at the Fed. He's the architect of the Mar-a-Lago Accord to devalue the dollar to bring back manufacturing. How do you devalue the dollar? You let gold go higher. How do you let gold go higher without outright revaluing it by the Treasury, which they could? Well, what if you have an entity like USA Tether, who is continually taking the interest, which according to, what is the name of the act? The Clarity Act, I believe it's called, you can't transfer the interest between the holders of the stablecoins. So the issuer keeps it buying gold, 30 tons a month. The act of gold going higher and higher and higher and higher devalues the dollar more and more and more and more, which enables selling manufacturing. They continue to do so. It grows organically yet synthetically. In other words, the demand for the short-term treasury is synthetic through the movement of money in the Stablecoin Act, the Genius Act. The interest isn't transferable. Throw it into gold. Gold goes higher. The dollar goes lower. You can sell your manufacturing around the globe. Van Eck Fund says 180,000+ if indeed they lose the reserve status. And that's been my thought all along, as they're trying to default softly on the reserve status. As Vice President Vance says we can't afford to be the reserve anymore, or the knucklehead Jared Bernstein, the previous economic advisor for the Biden administration, who did write a report called Dethrone King Dollar, which advocates the same thing. We can't be the reserve currency anymore. Triffin's dilemma, which we've talked about before, and it will never allow you to have a trade surplus. So you don't outright talk about it. You throw out hints, but you devalue the dollar massively, like everyone around the world has ever done to us, so that they could sell us their goods. Well, we turn the tables. We wickedly devalue the dollar by letting gold go to the moon. And then Judy's idea comes in. And, Judy says pack the back end of the market to gold. Now let's use Van Eck's example. If you sell a $20 million bond for 20 years at $5,000 an ounce gold, well, you owe 4,000 ounces of gold to the recipient in 20 years. But if you let gold synthetically go higher like this, organically but yet synthetically, and let's just say Van Eck was right. So you take $20 million and you divide it by $185,000. That's 108 ounces of gold. So instead of having to deliver 4,000 in 20 years, you deliver 108. The rising gold allows you to back the back end of the bond market and deliver a much, much, much reduced level of gold to back those treasuries, which are zero coupon. And the zero upfront borrowing cost allows you to bring back your manufacturing at no upfront cost into a devalued dollar to sell it to the world. You tell me this, people, how the hell else are you ever going to bring back your manufacturing? We make nothing. We're broke. We're insolvent. We're uneducated. Ray Dalio just came out and said 60% of this country has a reading literacy rate of under the 6th grade. So we're dumb, we're broke, we're insolvent, we make nothing, just in time for AI to come and kneecap all the jobs. So you have to bring back manufacturing. You cannot be reliant on China and the rest of the world to give us everything from aspirin to aircraft parts. You can't. Our children and our grandchildren have no future. And the only way to do it is to bring it back. Well, how do you bring it back? You bring it back at zero upfront borrowing costs, where when you pay it back, it's at a fraction of what it was when you issued the bond, into a wickedly devalued dollar by letting gold go higher. And the mechanism is by companies like Tether throwing all this money into gold that they get at the back end of the backing of the treasury movement or the stablecoin movement, pushing gold up organically. But it's all synthetic because it's part of the Genius Act. It's diabolically genius. And I think it would allow us to bring back manufacturing, to give our children and our grandchildren a fighting chance, because if not, we're dead. And I mean that. We're sincerely, mathematically, we are going to have a day of reckoning. And I think if there is any nobility in what he's trying to do, this is it. And I'm the only one either stupid enough or brave enough to say it publicly. I don't get much in the way of pushback. Really, I mean, I spoke about it on stage with Nomi Prince and Mark Moss and Brent Johnson and all these very smart people, and they actually agreed with me to a degree. So I do think that is what they're trying to do, is to look. Richard Russell, my mentor, said you got two choices, and this was 15 years ago. The Fed can inflate or default. Inflate or die, he used to say. Well, option number 3 is to grow your way out. Well, how the hell do you grow your way out when you have no manufacturing? Well, you soft default on the reserve status in order to sell your stuff to the world, but in order to bring back the manufacturing capacity, you have to first have the ability to do so. Well, zero upfront borrowing costs, sell the bonds redeemable in gold, and by the time they stand for delivery or they're redeemed, the gold price is so much higher, making manufacturing so much easier, that the amount of gold that you finally have to deliver on those zero coupon bonds is a fraction of what it was when you actually sold the bond. I don't know, it just seems like it could actually work. I don't know what else other choice we have. Our future generations are in big trouble if we don't do something. And to me, this is the most logical choice.
Well, that would be a massive default as well of the bond of the debt, wouldn't it? Because you'd basically debate treasuries versus gold, and the big losers would be like, I think foreigners own 9 trillion of it. The Fed owns 4 trillion. I guess U.S. investors.
Yeah, the majority of the debt is owned by the United States. I mean, yeah, 7 to 9 trillion by the rest of the world, but you look at all the money that's been chasing yield, leaving the banks and going into money markets. Those are all backed by treasuries. You look at everyone who has left their banks and went right in and buy treasuries.
Yeah.
And you look at what's backing Social Security, the IOUs, and all of this stuff. It's defaulting on the American public. It's much easier to do that than it is on the rest of the world.
Yeah.
And I just think that they have very few choices. They're few and far between as to what they can inflate, they can default, or this is another option to ultimately allow our kids and our grandchildren a fighting chance to grow and be productive in the engine. In other words, I think we're moving away from globalism to mercantilism. We're going to take care of ourselves and our home first, and forget about what seems to be a losing game, and that is globalism. And I think that's the trend you're seeing with the BRICS, with all of these countries. They're building and strengthening their own monetary ecosystem, trading their own currencies over bridge networks that are not compatible with SWIFT, settling imbalances in gold. And very similarly, I think we will do something quite similar, tying gold to the back end of the bond market, as Judy says, and using the Genius Act to synthetically create demand for the front end, keeping rates low.
Yeah.
I mean, it just, I don't know how else you get out of this. I don't know how else you look your kids or grandkids in the face and say, you too have a great chance at following your dreams.
They don't care about the debt, because if the debt becomes worthless, they won't have to finance it. And
Right.
if all the jobs are bad, yeah, you debase the currency, the debt. And that's why, I mean, you've spoken about this recently in one of your interviews. That's why the big money wants physical gold and silver, because they know that treasuries and all other government bonds in the world are going to become, they're not going to default, they're still going to be there, but their purchasing power is going to plummet, right?
Of course. Why would anyone want to take our treasuries and hold our dollars for their goods and their services when we debase the currency continuously, which has a direct correlation to the value of the treasuries? And if we don't like what you're doing, we're going to take your treasuries. Never mind what we're doing. We don't count. We're the U.S. and the reserve currency. It's this type of, the hegemony that's worn very thin on the rest of the world, I think, is manifesting itself in selling of treasuries, accumulating of gold, moving away from the dollar in settlement and in reserve. And over time, that chips away at both. When you look at, for example, the countries in Southeast Asia, the Asian, as they're called, countries, have 800 million people, twice the population of this country. They're China's largest trading partner by far, and they're all signed up to the Cross Interbank Payment System, the CIPS, let alone the M-Bridge. So the trading in local currencies not only strengthens their ecosystem, their monetary ecosystem, their own infrastructure, their own destiny, it weakens ours. And the lack of settlement in dollars weakens the settlement status of the dollar. And when you have all of those dollars around the world, which all these countries would have always accumulated for purchases of oil or global trade as the reserve currency, they would take the excess and put them in treasuries. Those treasury purchases kept rates low, kept our goods prices, or our asset prices high, and the goods we buy around, at Walmart and Target cheap. Well, those are ending. And so now they're not trading in dollars anywhere near as much. They're trading in local currencies with each other over SIPs or M-Bridge, and not stockpiling dollars and or treasuries. Instead, they're doing so with gold. This is something that is manifesting. And when you look at the Asian countries, they're China's largest trading partner by far, and they are now signed up to a system that is not compatible with SWIFT. This is a growing reality. And I think the people in the United States who are pulling the strings right now, thank God, I think they understand this.
Oh, I
And
think
they're
so.
doing something to combat it quietly.
Yeah, and even like the big money in the US is not just like foreign nations and countries. People like Ray Dalio, I mean, in his interview with Tucker Carlson, he says, gold is the new reserve asset. It's the only store of wealth. So I think, yeah, all roads lead to gold, I
Well,
think.
who's been importing it all? Who's been standing for delivery at these levels? That's the question that the media has missed completely. They can talk all they want about, yeah, look, gold's gone up, silver's gone up, or they'll paint it negatively. Yeah, it's topped, it's overbought. They missed it completely. Completely. And what they missed is not it, but who. Who is standing for delivery for 15 straight months to the tunes of hundreds of billions of dollars? Who is bringing in between 40 and 70 million ounces of silver every month? No one's asked that question, and it's never happened before. Less than 1% of contracts on the Comex have stood for delivery my entire career, 35 years. Never. And all of a sudden, you're seeing massive deliveries every month, even those that are not a delivery month. You look at December, which was a delivery month. They raised margins twice to knock off the speculators, right? Drop the price down into the new year. And what do you see happen? It's the largest delivery in the history of the Comex market for the month of December for silver, 63 million ounces. But who's doing it every single month? Every month. And then it just so happens that silver is now a critical mineral. Oh, well, that's a cool coincidence. And it just so happens that they are now stockpiling it for a national stockpile. That's a cool coincidence. And it just so happens that they're now going to put government-sponsored price floors under the price of these critical minerals to incentivize domestic mining. That's a pretty cool coincidence, too. Just like they front-ran gold before the BIS changed it, to tier 1, and they front ran it for 4 years and repatriated it all from the Bank of England and the New York Fed. The big money sees what's coming, they know what's coming, and they do things. I'm going to use a little bit of profanity, and please forgive me, but I want to get the point across. Whoever is doing this, every month, month over month over month over month, they do not fuck around when they're spending hundreds of billions of dollars. They know where the puck is going. Wayne Gretzky, the greatest hockey player ever, his famous line, I don't skate to where the puck is, I skate to where it's going. And that's how he scored more goals than anybody, because he knows where the puck is going. And so do these people. And so price is an ultimate tool of misdirection. They used it to shake all the leverage out of the bushes, and it worked. And now the folks that aren't using leverage or margin to stand for delivery, well, they say, thank you for the 40% drop in price. We're going to stand for delivery. Have a great day. And that's exactly what they're doing every single month. And when you realize people who have that kind of money in the billions, who are doing it not just one-off, but every single month, every month, well, I have a feeling these people know the people making the rules. And so price will do nothing but try and throw you from the back of the bull. That's what the bull wants to do, take as few of you along for the ride as possible. But if you have strong fingertips and can hang on, you just emulate what the biggest, most well-informed, forget about how wealthy they are, with hundreds of billions. They're the most well-informed, and information is everything at that level. They know it. They were told what to do, just like all of the buying and repatriation in 2016, 17, and 18, and somehow, by the grace of God, 2019, the BIS changes gold's designation. Just like the front running of all this silver accumulation for 15 straight months, and somehow silver is now a critical mineral. And China's going to restrict exports.
Yeah.
People missed what they said in November. They're the second largest producer of silver in the world. All the domestic mined silver is going to stay there for domestic consumption. So everyone is prioritizing this stuff, and they're using price to misdirect the masses. Don't look at it.
Yeah, it's the same people, Andy, that in 1933, just before Roosevelt came to power.
Shipped it offshore.
Yeah, they shipped it to Switzerland, and then, they did very well because he revalued it like a
That's information, brother.
yeah,
Information,
yeah,
man. The information
yeah.
is worth more than anything. And
And
the
we,
metals are worth more than the dollars used to purchase it at
yeah.
that point, too.
So Andy, as we wrap up here, could you tell the viewers? I'm sure a lot of them know you already, and hopefully they have dealt through you and my link. But for those who don't, how they can get in touch with you if they are looking to start stacking. And I don't think it's that late. We're not late in the day. You can still, we've had a big correction here. And people always say, oh, it's too expensive. But, they've been saying that for years, and here we are. But yeah,
Well, you could say the same thing about the Dow Jones. I started in this industry 35 years ago. It was 2,100, and now it's, almost 50,000. You could say the same thing about Bitcoin. You could say the same thing about any asset. Look at house prices, everything. It's not too late. In fact, gold and silver are two of the only assets that never have really been allowed to find price discovery, where everything else has blossomed in the face of easy money and low interest rates, where gold and silver should have, if it weren't for the concentrated short positions of about 8 Western bankers. But that's for another story. Anyways, the bottom line is the best way, Mario, is to send us an email at info@milesfranklin.com, where we do publish some prices on that website that you're showing there, only up to about 10 grand. But we will not be undersold on anything. If you request our price list, you can also ask any questions on anything you've heard here or on other shows or information on IRAs or whatnot. But our prices on just about anything will be second to none in the industry, as close to, certainly. And what differentiates us from others is, even though I live in Florida, where I've been for 5 years, where we've had a corporate office in Minneapolis for 35, we've had a satellite office here for 20, and I've been here for 5. When I left my corporate office in Minnesota because we're licensed and bonded in the state of Minnesota. It's the only state that regulates a federally non-regulated industry. Most of our competitors won't do business in Minnesota. That's what differentiates us, is that we are licensed, bonded, and background checked every year, which holds us to a far higher standard. So info@Miles Franklin. Just ask for the price list if you want. Please put in the subject line, Mario sent me, heard us on Mario's show. Any questions, no obligation. If you just want the price list, great. If you want to be contacted, maybe put your phone number down and say so, and we will get back to you promptly.
great, Andy. Yeah, interesting times, and hopefully we'll speak again soon. And yeah, nice speaking with you.
Mario, it's always great to see you, and I hope you'll get over here to Florida and resume what we started last year, a nice golf relationship. All my buddies are wanting to see Mario, so come on back anytime, and I'll look forward to picking up where we left off. As always, brother, you stay well.
You too. Thank you.